I think a better term is like now that I'm hearing this, I was like maybe generational knowledge might be the better aspect, because a trust fund baby, they can blow it away on some dumb stuff, and the fortunes are gone.
Right.
Yeah, I talked to the family offices where a lot of them are setting up rules now around that. So one thing I hear a lot, for example, is make sure in the trust you write that if you ever marry somebody, they have to get a prenup.
That's the other thing is like, how do you raise your children?
Yeah.
Right? Without that sense of entitlement, knowing that they come from parents that are highly more motivated or more driven, or that is more established. And like what kind of things you want to instill in them so that they don't do dumb shit. I mean, they're going to do dumb shit regardless. They can do it broke or they can do it like really rich. It doesn't really matter. They're doing dumb shit regardless.
I actually want your opinion because you have kids. Because I know there's
I'm jealous of everything.
We are irresponsible adults.
I got a baby sister. We're like a 14-year age gap. I did the same thing with her about like talking about like, the rich dad, poor dad. And when she read it, she's like, am I a liability?
Hey everyone, thanks for tuning into the Fit and Frugal podcast. I am your host, Tawny Wynn. You can find me on IG at Tawnysaurus. Today I have some friends with me. You know what we're going to talk about today? It's my least and our favorite word of being of commercial real estate investors. Motherfucking OPM. All right. How do we feel about that? Like, what do you think the biggest stigma around using other people's money is for investors?
From the investor's perspective, greed is always like that first layer of like, why do you want my money? And like, you're telling me this story. How do I know it's going to go to good use?
Right. Or when they don't listen to you too, because sometimes you get investors from different industries and different fields, and they feel that could be transferable, and sometimes it's not. But you have to have patience to, teach them that it's not transferable.
Like why they should give you $100,000? What are you doing?
No, it's like I invested my money this way doing this unrelated to real estate investment. Why are you not doing it like this here? Like that usually is not the case because, if you do the same investment multiple times, you know what works and what doesn't, especially in different markets.
Yeah. So I think it's like heavily saturated that everyone's using that as like a little catchphrase or a little, like a hook on Instagram that's like, oh, I bought this deal for X, Y, and Z.
Serve money down.
Without using any of my own money. Follow me to find out more.
I actually enjoy the concept of other people's money, but people think of it more in the sense of how do I get money from people to give it, like investors. I think actually the biggest OPM that no one talks about is lending. Like if you think about it, a lot of these things are government backed. They shouldn't be giving us this good of terms. And why is that the case? It's because the biggest other people's money is really the lender at the end of the day. And that's something people don't discuss enough. They constantly think about, how do I gain more money from and like produce influencing the character that I can extract more money and more value from other people with. But really the biggest other person's money is the lender. And then everything else that you use to figure out in the middle, that's a harder question to answer.
Like how you get to that stuff?
How you get to that stuff. Yeah.
Asking the lender or being in front?
Being in front of them.
Yeah. I think that's a good way to put it because I think creative finance is just another method of alternative lending, right? It's just a different marketing strategy or a different word on top of that. But at the end of the day, it's still lending and you're still using it from a bank.
Right.
Mainly. Interesting.
Yeah, you need a person or entity to be the one taking the biggest risk, right? So it could be a bank. Traditionally, it's the bank. Or it could be somebody else. Or it could be another entity that uses buying your debt.
Yeah. Why is that word like, as a person that's never invested in a deal, like why is it so hard for them to grasp that concept? It's like I use other people's money, right? But when people, let's just say, see that word on social media, like how is it perceived? It's like, oh, you use other people's money, and then they make it sound so easy. But as capital raisers, we kind of know it's like it takes work and a lot of like love and tenderness to put into those relationships for people to give you that money, right? Based out of trust.
Yeah, like I like the guys that have been vetting us for like the last year. They see what we're doing, they're on our distribution list, and then like now after like 2-3 deals, now they finally like want to invest. But that takes a lot of time and patience and just relationship building and trying to build a bridge rather than burn a bridge with these various personalities.
Yeah, like why should I give you money versus why should I give you money, right?
So it comes down to a relationship, like, you know, like how is that going to work? Like, I mean, the bird just met you.
Yeah.
Right.
It's like, yeah, you can give me all this knowledge and like all these golden nuggets. Listen to this, go on bigger pockets, like educate yourself and go talk to this person, go talk to that person. But at the end of the day, like what is it? Is that one thing that it comes down to?
It's how much.
Go ahead.
I think it's how much value you provide. Alex Ramosi mentioned this, but you are as memorable as the last piece of value that you provided. And so there's this thing I mentioned earlier about goodwill versus revenue generation, right? Your goodwill grows significantly faster than your revenue usually does. Why? Well, the reason is because if you have goodwill for one person, they tell 2-3 friends, you can double, triple that versus doing the same thing with your income streams. Every time you take more revenue though, it garnishes from your goodwill. And so it's a question of like, how much goodwill can you build before you decide to skim a little bit off the top? And there are a lot of people who want to garnish it ahead of time through, hey, take my course, hey, join my mastermind, hey, blah, blah, blah. It ends up sort of buying the goodwill in order to maintain an income stream in the meantime. But you miss out on possibly like higher end transactions. And the reason I mentioned that is because you are as memorable as the last product that you offered them. Your time is still worth something. When you see a video and someone says, you know what, here's how you invest, here's how you gain value from it, and that person watches the video for free, but they got, $100 of value from it, they're going to say, give me the next thing. What else are you selling me? Then you're going to say, okay, maybe I have this course. It's $1,000, but they all of a sudden made $50,000 because they saved some money on a single family home they bought. And then you say, okay, well, now the next course is $10,000, but you made $1 million off it. You're going to keep saying, give me the next thing up until maybe this product is now $1 million product, but you'll get $1 million of value. All of a sudden, they don't even want to brag about it anymore. They kind of keep it like, okay, thank you. We've exchanged enough goodwill versus revenue that I don't feel the need to like keep supporting you or spreading your word. And that's kind of what I was referring to in terms of value versus goodwill versus revenue.
I think that also there's, and we know that we have dealt with this before, there's a different way of thinking about it depending on who is this person you are borrowing money from. Like I said at the beginning, it could be a person or an entity. If it's a person, yes, you have to build on the goodwill. You have to actually, because this is it could be like they don't have a lot of money in comparison to a company. So this is their money that they're willing to invest for the future. Versus when you have a company or an entity just being a limited partner with you, they care about the numbers. They care about the risk. They might build relationships with you, but at the end of the day, it's like, okay, are you going to lose my money? Where's the risk? Like there is a different type of mentality that they have. So it kind of depends on the education level too. On like, do they have experience? Do they have experience? And then from there, you can be like, okay, what is my plan of action? How can I talk to them about this deal, depending on how much they know?
Yeah, because 100,000 could mean differently to different people that's had a W-2 that's been saving all their life. So it means more to them than a person that can just make that right in like a month worth if they actually know how to multiply money through other means.
That's a good point, because like if you're talking like family offices, yeah, they want to see the returns, but at a certain stage, it's more about wealth preservation. And so, yeah, the talk tracks do change from like, obviously an entity to an individual. But then again, that's another level of relationship building that you got to create with that entity.
Yeah, I think that's another word that's been circulating a lot lately. It's like, go find money from family offices.
Yeah.
Step one, Google family office.
Deal and it's a JV,
right? Because
they want voting rights.
Yeah, they're like, hey, go talk to a family office. I'm like, okay, Google, like, take me to a family office. Like, where do I find these people?
You guys don't have rich uncles that you just talk to? That's like a family office, right?
What is that even?
Your uncle Steve Jobs. Got one of those.
Godfather counts.
Yes, I think that's why it's really funny. It's like, how does a normal person reach that capacity to where they can find large amounts of money, right? It's like, what the fuck is a family office? Like, someone enlighten me,
I mean, it's just 2 steps, right? You raise smaller checks, $50,000 at a time. Eventually that becomes tiresome and you decide I need to raise bigger checks. And that's when you go to a family office and say, here's my track record. We've outperformed on like these last 3 projects. You know, let me know if you want to work together.
We need $5 million.
We need $5 million.
Casually on a Tuesday.
And then after a few deals, you come to the realization that the effort that it's required to do a smaller deal versus what you consider a bigger deal, it's about the same. Mm-hmm. So you might as well just go with the bigger one.
Yep.
Yeah, always go for bigger. Size matter, you know?
That's the beautiful struggle.
It's like, how girthy is your net worth? Should that be like the new dating vetting strategy? It's like, show me the girth of your
underwriting dating
eight to grower. Wait for it. It's gonna get bigger, I promise.
It's gonna get bigger.
This usually doesn't happen.
There's seasons.
What seasons are we talking about?
Cold weather.
Okay, that season.
Like cold factor.
Down market.
It's funny.
Yeah, because I was kind of like ruminating on that because it's like, what's another word that kind of captures your attention when it comes to raising money? Because people are betting you back and forth, right? It's kind of like what you were mentioning earlier, just like kind of pin them against each other and just kind of hear about what their credible aspect or worthiness is.
Yeah, I think most people have this problem where they figure out about syndications and they only know one syndicator. And the way to really balance that out is you end up having to get syndicators ideally compete against each other. So the easiest way to figure out how a syndicator might perform from at least a perspective where you haven't invested before, ask another syndicator what they think about this person. And they'll be a lot more honest than directly talking to a syndicator themselves, because then they feel, okay, there's competition, I need to step it up. Obviously, they're going to maybe trash talk a little bit about the other person, but you wouldn't get that, talking to someone who's a partner as a referral, for example.
We actually wrote a book on how to vet operators, and because when I'm with our fund, we'll go active and passive, right? So on the passive side, we've learned certain things. At first it was everything's fine and dandy, but eventually you want to hear how your teeth got kicked in and how did you overcome that setback. And the last thing you want to do is lose capital. If it's your investors, especially other people's capital, then that's your reputation that's on the line. And the investment world is so small that the word will get around like a fire.
Mm-hmm. So I think coming in, from that aspect, it's just they always ask you, do you have money? Do you have money in the deal? Do you have skin in the game? And I think that comes second nature. It's just kind of the humanity aspect behind it. It's if you don't put your money in this deal, why should I? Why do you want my money versus why don't you put your own money into it?
How much faith do you have in that deal versus,
Yeah.
Yeah, but that's a mentality. That's really not, I have never found an investor that asked me, do you have money in this deal? None of them have ever asked me that. And I think that's a mentality because if you have an experienced investor, they will know that there is so much more to do. It's not just them. It's they're not buying the deal by themselves. You have to go raise money across the line. And then you have managing the asset itself. He was saying, finding the right operators. There is a lot of work. So you want to leverage on my experience on how do I do that? That's my value right there. So it's like if somebody tells you that, then you have to express to them, this is what I bring to the table. It's not per se capital, because that's your contribution. My contribution is experience on how to do all of this so that you don't lose money.
Yeah, I agree with that. When you talk to retail investors, yes, it's a very important thing. But when you are talking to a family office, they're going to not actually care. Because what amount are you going to really put that's comparable to a $5-10 million check? So.
Yeah. They will be keep it. It's
keep it.
It's complicated.
Keep your $500,000 chump change. Yeah, that's why I kind of want to highlight that perspective, is because people always ask us, right? Hey, how much money you got in the deal? I'm first of all, why does it really matter? Because there's lack of understanding out there that is not really about the money. But if you're doing it passively, you should be trusting and putting your faith into that person, knowing what they're doing. to give you the projections and the returns that they, I don't use the word promise, but what's that word what's the legal term that we can use? That's not
under promise, over deliver. That sentiment.
Yeah, because I'd be happy to look at it like a 2 cap when I know like that person is just like they know what they're doing. They're just writing them really conservatively because I trust that person, rather than looking at someone that's just like, I'm gonna give you like 22%. I'm like, oh, okay, no, like red flag.
Yeah.
Oh, there should be like a red flag in syndication.
Well, that's the thing too. Another common word is conservative underwriting. Like, really, how conservative are you? Like, a lot of end investors or retail investors will kind of like take their word for it. But, as being a part of a fund is like, we got to do our due diligence on the investment summary. Are the numbers really adding up? How's the team? Things of the nature. So that's why, like, and then again, it goes down to relationships and knowing what calculated risk will pan out in your favor. And it's a lot of times, it might be a guess, might be a feeling, but you want to be as educated as much as possible.
And don't depend on like, one of the things is it's important to know that your exit strategy is not depending on the market too. So like if you're trying to convince somebody that your exit strategy is a refinance, that to me is like, okay, how good of a deal is this? Because if you're highly depending on a refinance, then you're highly depending on interest rates, and you can't control that. You can control it up to a certain point based on the value that you can raise. You can raise the equity in the property, but if you highly depend on that interest rate, you're kind of hooked already. What is like? Can the actual? I also buy businesses. This. So can they actually, in my head, can the actual business pay for the debt without recurring to a refinance? In this case, in real estate, like, can the actual property pay down the debt without requiring a refinance?
Banking all of it on like year 3,
Yeah. And one thing that's hard too is like, the more complex the product, the more tail end it is, the better the returns are going to be. But that's also the hardest to explain to somebody who's a retail investor. Why do most of them go into multifamily real estate? It's the easiest thing you can understand versus single family homes, right? But there are leveraged products that you can, mitigate most of your risk from, that are actually better returns, that are going to be really difficult to try to explain to somebody who's not that advanced. Example I give is like a friend of mine, they bought this warehouse building, $7 million off-market deal, appraised at $8 million. No one was going to invest with them on that one, but the investor that gave them the down payment helped them co-sign the loan. They knew that it was worth, $20 million, which is what they evaluated and appraised at once they re-signed the tenant. But there was also huge risk because there's a chance the tenant doesn't re-sign, so then you have 6 months, a year before you can actually refill it, et cetera. But they knew the margin was there. It's literally 30% on the dollar at the purchase. And so how do you explain that to a retail investor without them freaking out when they're like, hey, we didn't resign, but we have actually, 4 or 5 tenants that are waiting to just sign it at anywhere, near market rent. And so it's the more black box the product is, the better your return profile becomes. But the less that people understand it, the harder time you're gonna have trying to raise it from a retail investor.
Yeah, because that level of proficiency is like the language itself that's speaking, like that's spoken amongst us is like already different for most people. And then once they see like certain buzzwords, they're like, okay, I'm gonna fixate on that one word and like just go hard on that word. And then they just get like off of a tangent of only understanding that one aspect of like how multidimensional like investing really is, because there's so many ways to make money. Like, you don't really have to do just like the one thing, but maybe it's like the one thing that at that time. But if you're not open-minded to other concepts, then you're kind of stuck in playing in a box that like, if that doesn't work, then that's all you know.
Yeah. And so one thing syndicators have done is try to make the terms easier to understand, but they're also sometimes actually worse for investors themselves. So one thing I see a lot, for example, is Pref A. They do like a straight 10%. It's like, that's literally the worst. Yeah, that's literally the worst deal they can get, because you don't have the protection of a security, like a lien or any sort of loan. You're just straight up hoping that it actually makes profit. And if it doesn't, they still don't have to pay you because it's a preferred return. It's not, monthly. You can like extend it to any period. I can get you a 10%, loan, and you'll have the backing of the actual asset versus just like preferred return upside, 10%, and you're not getting a portion of the promote. You're only sticking with like
10K, 10 to 12K annually.
Exactly.
Yeah.
Right. And it's like, but they don't understand that that's not protected. Yeah. Right. They're just like, oh, it's preferred return. So it only goes up.
Right? Sounds good, right? It sounds good.
Right.
Can we talk about what do you guys do with making sure that your underwriting doesn't get out of hand? Because I've run into this that we're underwriting, we have different phases. We have like we call it a preliminary underwriting, which is like the beginning, and then after you do you get some information, you got to underwrite again because you have more information, and then you get under contract, you got to underwrite again. So sometimes and I'm also like I've done this unfortunately, where you try to be optimistic about like, okay, so what would be like the best case scenario, and then you try the numbers to say what you want them to say. And then it's like, how do you guys stop yourself from
this is a big return?
Yeah, that's like, okay, this is the worst case scenario. Okay, good. Because if we know like we get performance from all of these people, and usually when you see the performance, it's just like a beautiful thing, You gotta give 50% down. So that's different. Like how do we on our side, stop ourselves from making the numbers say what we want them to say?
Two things. Actually, it's I split the role of deal finder underwriter with the capital raiser. I'm obviously the main raiser in my partnership, but my partner is obviously much more optimistic than I am. But I have to step in and say, this is my reputation. How do we make sure that we can get these numbers to work, that I can pitch this, but enough that I don't feel dumb if we don't hit it, right? And so it's that really. It's a separation of powers. I have to fight him because I don't want to look dumb if we can't hit these. It's my reputation. It's not his. Yeah. He's more anonymous than I am, so he doesn't have to worry as much. But he's the one doing most of the underwriting, finding the deals, and talking to brokers.
Yeah, because it's good having a devil's advocate, because if you can't battle them on why your numbers should work, how are you going to bring it to other people? Like you have to know your numbers like inside and out, flip it inside out. Have like,
how are you going to tell a story?
Best case, worst case, and like where it's actually performing at, right? Because like for me, worst case would just be like at least 50 under, right? Like if we're super underwater, like what the fuck are we going to do? Like if the building's on fire, what are we going to do?
So one thing, that happens too is like now we have a existing body of buildings. We can go back and we fight about it too. Recently he underwrote a building in Florida, mostly buy in Florida, and he was like expense ratio was like 30%. I'm like, how's that possible? We're only doing 3% on our existing buildings. How are we going to do 30 on this new one? Right. And so it's just stuff like that where it's like, if you have an existing body of work to go back to, it also helps a lot.
If you have the same building in like the same area.
Not even the same area, just like it's in the same city.
Same city, the cap rate.
And one thing that I also fight about is like rent increases, right? So if you bought any building in 2022, especially the latter half, and you projected rent increases for the first year, that's
you're a happy camper right now.
That's like, and they might be like, oh, it's only. I saw a deal in Corpus Christi, Houston area. They're like 5% rent growth for the first 2 years. I'm like, Houston's already been like, it's like flat. It's going to go down soon, probably a bit. It's not going to collapse, obviously, but you were expecting a 5% increase, and then a 5% increase on top of that prior year, right? So it only stacks up, right? So the more you change at the front when you underwrite versus near the end, the better the number looks for your IRR. And so obviously, I was like, there's no way I wouldn't touch that at all. But it's like it's something I noticed that a lot of underwriters are probably going to put, especially if they bought in 2022.
Yeah.
And even if the market is good, you still have to wait for leases to be up for renewal.
Exactly.
So it's like you're still gonna wait. So you don't know.
Imagine your target rents are now below what you underwrote for in the first place, right? And then your margins are already small. You're like, 15% IRR. Good luck. Your cap rate's 2% higher than what you projected.
You know what's funny? I just realized, like, you know how like we speak this language, and there's people that listen to this, be like, what the fuck are they talking about? And we're joking about like 2% here, 3% here, or whatever. And it kind of makes sense, right? Because we have like this digital spreadsheet or something that I sometimes cry about because I see it in my sleep. Like in between breaks, I'm just like, I gotta cry this out. I can't look any more fucking spreadsheets till tomorrow. And I think that kind of answers that question, right? It's because you want to sell yourself on your own numbers, and then the next thing you look at it, I'm like, all right, I'm gonna give myself a different fucking scenario. The market fucking does this, I go back and they're like, why are you so fucking pessimistic? I'm like, no, like the shit just went on in my dreams, like after
just lay out the worst story, and write around it.
Exactly. Like, what's the worst crime that could happen in 1989 that could like repeat? How is that going to affect it? How's the media? Like,
you may not be 2019 or 20 where you could be like 50% unoccupied. But
exactly.
You may be 30% unoccupied.
Yeah. If a fucking plague hits us right now, like, what the fuck are we going to do? Like, are we going to survive? Like, you know, as a species, or just an underperforming asset? Like, how do we get out of that? You know, so that's kind of like bringing it back to like normal terms. It's just like that's what conservative underwriting is to me. It's just like if the worst thing that could happen to your building, like, how are you going to get out of it? And it kind of comes down to the operators and them knowing what they're doing outside of just projections, performing, and like selling it, right?
It kind of goes back to your point, like that teamwork aspect of just having that second, third, fourth set of eyes just to play devil's advocate, because you kind of have to. And as a capital raiser, like for me, I was like, oh yeah, everything's a great deal. Let's go raise the capital. But you know, I need the underwriter to rein me back a little bit. Here's a real story,
down.
John.
Like calm the fuck down. This is not your $1 million. This is like 5 or 10 other people's hardworking money, right? That you're gonna put to work to make your dream work, and like you're going after all these things, but you kind of have to ground yourself to understand it from their perspective and have a little more empathy in terms of like they don't understand real estate or speaking that kind of language like us, but you know, it's not considered them. It's just a different thing that they do. And how do we simplify that in terms of like making other people's money less evil or more efficient, instead of just telling them I can make your money on your money? There's a lot of people with money that don't care about making more money. They care about like making like a bigger impact in terms of what their money can do for society, not just like, hey, like I invested in like $500. You know what I'm saying? Like, okay, cool. Like, and what? They're still filthy rich. You know, but there's a lot of people that go into philanthropy like with a bigger understanding of like, hey, like, yes, like I am really high net worth, but like, what are you willing to do for people? Like for people that started where they started, right? The middle class is getting fucking tremendously fucked right now. And like, how do we bring that to the table of not even like pitching an idea or pitching a sales deck, but just like selling the vision of like, hey, we're here to actually help people and like bring this to light that not all syndicators are made equally. Is that a thing? Not all of us are evil.
Well, that's why when you're building a company, regardless of what it is, you have a mission and a vision statement. You know, because you have to bring that purpose into your company. If you don't have that purpose, then it's all about numbers. You know, like and trust me, like if you get good at the numbers, you can make a lot of money. But it's just numbers. Like at the end of the day, down the line, you're gonna feel that like, okay, what's this for? You know?
You get buried with money.
And actually, and this may sound unrelatable as fuck, but it's hard. Like once you have that amount of money, whatever it is, like whatever you think about, like a big number, think about that big number. How you manage it, it's stressful too. Because like, let's say you have that amount of money.
Sorry.
Yeah, exactly, right?
Like, who gave me all this power?
Yeah, it's like, okay, how do you do that?
Right.
What do I do?
Because if you think about it, like I'm pretty sure all of us want generational wealth. So you're not really working for yourself at that point because you have that amount of money. But I mean, if you're responsible, you can go and spend it all.
My kids
we live in Vegas. We can spend it all.
Hookers and blow, baby.
Yeah.
Hookers and blow.
I think a better term is like now that we hear this, I was like maybe generational knowledge might be the better aspect, because a trust fund baby, they can blow it away on some dumb stuff, and next thing you know, the fortunes are gone.
Right.
Yeah, I talked to the family offices where a lot of them are setting up rules now around that. So one thing I hear a lot, for example, is make sure in the trust you write that if you ever marry somebody, they have to get a prenup. That way the kid is like obligated to tell their partner to get a prenup, right? Or other things around like usually the grandkids are the main beneficiaries of the trust rather than the kids directly themselves. Right. And the idea is then that your first generation after you will actually pass that knowledge down. in order to like, because they have to learn it because they're the ones that don't have as much access. Obviously, also you can cut it so that they can't touch it other than for education, etc., whatever resources.
Yeah.
So yeah, I admire that a lot about like when I talk to family offices, the amount of planning that goes into making sure their kids don't turn into trust fund babies, because we've all seen what they turn out to be, right? So
then you have the part that they also like the really 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 well off family offices. When you see for example, like the universities funds, like they have billions of dollars because of this, because they don't have that kid or that generation that goes and spend it all. They keep accumulating. So imagine the power that we can have if we have that as well. That we can just have all of this wealth and we can keep passing it on if we have some type of like mechanism or system so that the next generation doesn't ruin it.
Yep.
You know, just at the end of the day, money is just a vehicle. You know, you do whatever you want with it.
And you come from an Asian heritage, like that is called a spank with a ruler or a slipper. Something, you know. He's not really violent. Just kind of.
Do you want to talk about this? Something.
No, I wasn't really raised in like physical violence, but I think that's the other thing is like, how do you raise your children?
Yeah.
Right, without that sense of entitlement, knowing that they come from parents that are highly more motivated or more driven, or that is more established. And like what kind of things you want to instill in them so that they don't do dumb shit. Or I mean, they're going to do dumb shit regardless. They can do it broke or they can do it like filthy rich. It doesn't really matter. They're doing dumb shit regardless.
I actually want your opinion because you have kids. Because I know there's
I'm only one here that's I'm jealous of everyone.
We are irresponsible adults.
I'm here like my kids get nothing.
Because there's a fine line, right? Like I don't know about your background, but like I came up with nothing pretty much. So my parents worked hard, and then we've enjoyed that. But and I see it in them, like they want to give me whatever they didn't have, and that at the end of the day costs money. It just costs money, whether it's education or whatever it may be. It just costs money. So there is some type of gray line within in which you have to think, I want to give them the best things that I didn't have, but it also costs money. So how much money, like, okay, where do I stop? You know?
Yeah.
Because like if I had a car when I was younger, I could go get a job, you know, but if you give a car to a kid, they just think about, okay, that's my gift. You know?
Right.
They just go out and party. So it's kind of like, what's the line?
It is like with me, I don't really say dollar amount. I'm educating them on like the bare bones. Is this a liability? Is this an asset? You know, like, is this toy that you want? Is this really a want or a need? Like, can you resell it? Maybe like, can you resell it? Like, you know, my oldest daughter, like I challenge her, like she likes to go to Savers because here's a prime example. My son went to Dollar Tree, bought a roll of stickers just about a year ago. This fool took each individual sticker and sold it to his classmates for $5.
Yes.
And I said,
yes.
Like I was super proud, but then now it's a teaching moment. Like, okay, the market will correct that eventually. But like, you know, as a parent, we're just like, okay, he understands of like developing that momentum to generate income, right? And then now the second layer is like, now the second layer is like, okay, you want to look, is that pricing, is it fair? And you know,
drug dealing 101.
I got a baby sister where like a 14-year age gap. I did the same thing with her about like talking about like, the rich dad, poor dad. And when she read it, she was like, am I a liability?
Big time.
I'm like, yes, you're extremely expensive.
And I think that the cash flow for kids board game is what I think it really helps. So like whoever hasn't done that with kids, play, because it's fun and it's an easy way for them to understand. I'm like, wait a minute, you guys are passing in, you guys are paying me rent, or even like just like Monopoly, like you guys are paying me rent every time you pass in. Like, yeah, baby, this is why we're playing this game.
That's really funny.
Because they don't, like, you know, like maybe not all kids, but like I can tell them something and I just know it goes in one ear right out the other. But if it's like, you know, an activity or just like being around like a meetup, whatever, like I'm hoping it's just they slowly absorb that culture. But it's just, it's. I'm still trying to figure it out, guys. So you guys have an answer.
He's like looking at us like, why are you looking at me like I'm an adult, man? Like, I don't know, because we're supposed to be adults too. That's really fun. Like, what's the funniest thing that you guys have blown money on?
Real
we're
estate.
going there.
Real estate. Like,
We're going. Here's the funnest.
Funnest
real estate.
Funniest?
Funny or just fun?
Yeah,
in general?
like funniest. Like, you know, you shouldn't be like doing this, right? Because everyone always talks like, oh, look below your means, do this, do that. You know, like, I don't think, like, for example, like Dave Ramsey, like, cool dude. You know, people follow him for a certain reason.
Yeah.
Don't
Never
go
did.
to that.
So that advice is applicable to a lot of people just because people love credit and they don't have money to pay it back. So it's applicable to a lot of people.
Yeah.
But once you know how to use credit and you're responsible about it, then it's dumb in my head.
Yeah, because
That
that's
being
Now
said,
you want more debt.
yeah.
that being said, I did sign up for GoBundance like 2 years ago.
Mm.
If you guys
Nice.
know about that one.
Yeah.
Totally way beyond what I should be paying for, like, to hang out with a bunch of other
30K.
dudes, basically. Yeah.
Yeah.
So I was like, yeah. And I remember thinking, like, I'll get the ROI on it. It's like an investment. But it was just like me hanging out with a bunch of guys on different weekends at, like, you know, wherever in like Miami or like going abroad or something.
Yeah.
Or at least
Go
you have
hiking or something.
Yeah, like I
Yeah.
went to Croatia last year
Yeah.
too. It was
at
just
least you have the potential to make the money back.
I have the potential,
Yeah.
but really it was just like 10K to like hang out
Pay for richer
with
friends.
like richer friends. And I was like,
That's exactly what you pay for.
right. But I was also like, I should I have paid 10K for it? Probably not. You know, like that's my like big spend.
Yeah, that's pretty funny. Because
Then
sometimes
they
you're
look
like,
at you as a rich friend.
It was at first I was like, I'm gonna figure out a way to make money from it. But then I was like, everyone else here's a shark. They're doing the same thing. They're trying to figure out I'm like, all right, I'm like, of the group of like, I was number 500 when I joined, and there's maybe 30 of us that were like under the age of 30. You know, so it was harder to relate to them as well. So it made it a little harder to like connect. And I was like, I'll start hanging out with the guys who were already under 30 anyway. So I was like, we'll just. I didn't renew it this year, but yeah.
I might join.
yeah, it's kind of like it's the same lifestyle that you're doing, just in a different group, right? So
Yeah.
just hanging out with different friends or
Pretty much.
friends, you know.
Yeah.
People are like, why do you go to masterminds? I'm like, I just pay for friends.
Yeah.
That's the sad thing. You pay
It's-
$1,000, you get around different circles, have different conversations, but you're initially as
If
an
you
adult.
play it right, I mean, that's definitely the way to go. It's like it's kind of like joining a fraternity or sorority. And everybody thinks, well, you're just paying for friends. Like,
It's way more expensive.
it's way more expensive. Yeah, some of these masterminds are like,
We're paying up to like
Way more.
$25,000-$50,000 a year as investments,
yeah.
but you're just paying for richer people.
I should have
To be
joined a
in your life.
fraternity. It would have been cheaper than this
You
mastermind.
get hazed a lot more.
Yeah.
So none of those are things. You guys never bought like things that you were like, that was expensive, but I enjoyed
Oh.
it.
I don't really like things.
I think in my in the early 2000s, late 90s, I'm kind of dating myself here. It was sneakers and DJ equipment. Like I just like as soon as like I'm gonna get a part-time job, I'm like, oh, I got $400, $500, $600. Let me see how I can spend all of this. It was,
Yeah,
I was totally
Yeah.
responsible. Yeah.
Nice.
I think that's one habit I'm gonna break is like I'm obsessed with merch because I think I grew up like an emo kid, like going to rock shows, like t-shirts was all I can afford. You know, before I like made more money. Like now that's still like in my blood. Like I still obsessed with merch. Like I don't buy regular clothes, but I'm like I'm going somewhere like I want that because you kind of see it as like a little what are those things called memento of like your experience or like
The memories associated.
You want the memories associated with it, but at the same time you're blowing it. It's like fucking expensive. It's like $50 a t-shirt, right?
Yeah.
Or if you go to Mastermind, you get a shirt. That shit cost me like $5,000.
Yeah, right.
I'm pretty much wearing a $5,000 t-shirt that's made for like $3.
I paid $30,000 for this hoodie.
Like fuck. So that's what I'm saying. Like that's kind of like a new world flex right now that we are dressed differently. We can say like, yeah, I'm frugal. I save money here, but then they look at what we actually spend money on. It's like we have this track record of like I have this Mastermind shirt that cost me $8,000.
So you guys have not bought like NFTs or any of that stuff?
Oh,
Shoot,
buy
that's the
stuff
case,
on
man.
I'm just saying.
All those meme coins. Oh, yeah.
Well,
2020, 2021, bro.
I never held it. I bought them and sold them. So,
I never got that deep into it.
I never sold at the right time, but yeah.
I know I'm too dumb to like touch stuff I don't understand yet.
Yep.
So I'm like, the crypto stuff was just like a little too beyond me to be like, should I invest the time?
Yeah.
Way beyond me. But I was like, I see it going up. So 64,000 Bitcoin, dude, this is gonna go up to like 90. No.
Did you know that the COO? I read this. I don't know if it's fake news, by the way, but I read this. The COO of Bitcoin quit, and he said that it was gonna reach $1 million. So I don't know what kind of knowledge he has.
I hear those rumors every now and then on social media.
Yeah, but
they say that all the time.
Yeah, I don't know.
Yeah, that's funny.
My advice, and something that's probably never gonna leave me, is watches.
Oh yeah,
That's
That was really
I-
awesome.
Watches.
my friend Gabe does the same. Yeah, he's like always. He's like, hey, can you hold on this watch? I'm like, sure. It's like 25 grand. Don't lose it.
You're like, I'm the most irresponsible person ever. Why would you give this to me?
Yeah.
Yeah, that's why I keep them in the bank.
Oh, you keep them in the bank? Okay.
Yeah.
He like trades them on like the
I used to
Facebook
do that.
groups
I used
and
to
all
do that. Yeah, I used to do that. And it's kind of funny because I ended up just, my dad growing up, when he actually like started making good money, he got a Movado with like a diamond in the middle. And I was obsessed with that thing. And then I realized it's not that expensive in the realm of like all of the luxury watches. It's like, huh.
Yeah.
But then since then, I've been like, okay, I always liked them. I have a collection I keep over there. Maybe I'll bring it over here. I'm not sure. But it's one of those things that I was trading them just to understand. I made 6 figures. So
Yeah.
yeah.
There you go.
Yeah.
I think I'm the youngest, so I'm very much of the lifestyle of like buy experiences, not things.
Mhm.
I move around every 2 years, so I always like toss shit out and figure out what's actually
You live
important.
in that backpack.
Other than that backpack,
Yeah.
I brought a backpack.
Yeah.
I'm like on a 1 week trip. I
Yeah.
can do it in a
Hung out
backpack.
with him multiple times. I'm like, where's all your stuff? He's like, this is all I got in my fanny pack. I'm like, all right, cool,
But
dude.
that's all you need, right?
Yeah.
Cool. All right.
And so I will throw 10K to join a group, or with a bunch of older guys that I'm not really going to click with, or throw 5K to go on a trip to Croatia last second
Yeah.
and like charter a yacht with a few friends.
Yeah.
But I won't.
But
I
sure.
won't buy a shirt that's too new. Like this H&M, it was $9. I bought them in bulk.
Yeah. So as you can see, like regardless of your income bracket or whatever your net worth is, like at the end of the day, we do want to save money. Like we do want to live below our means, right? So that's, I think the message here is saying like, yeah, like we are using real estate to compound our wealth and like build generational wealth, make more impact into the world and like leave more for our children besides just like monetary value. Like if you like whatever you heard today, like this is the first commercial boardroom that we've shot. So these are some of the topics that we talk about. Like I'm grateful that I get to share these moments with my friends because time is like the most valuable resource for me. So that's it for today. Thanks for tuning in to the Fit and Frugal podcast. I am Tani Nguyen. You can find me on Tanisaurus on IG. So just thank you to my friends for being here and, chopping it up today. You can find them on their individual IG. That's not on mine, please.
John Lopez. You can find us at 9 Doors Down on Instagram, YouTube, Facebook, and also 9doorsdown.com.
Nice. Jose Miguel, I'm the modern Xer.
Modern X.
Yeah. IG, everything. It's the same thing. Yeah.
Nelson Lin, Subtle Real Estate, SUBTLE. Subtle Real Estate is SUBTLE. That's pretty much everything. Or you could Google my name, Nelson Lin. I'll be the first thing that pops up. So.
And also, Dennis Nguyen. I'm at DWin09 on IG.